Here I am with Kamala, by the way, who I agreed to debate because I love to debate and I'm a very good debater. I love to debate.
That's debatable. Okay, very debatable.
How would you solve homelessness in America?
Okay.
You know, that's a great question. How can we solve? When I'm president, I will solve homelessness by making more people homeless. They should have less homes because you look at the homeless people, they're walking around and they don't have a lot of friends.
Okay,
and they're crazy.
Yeah.
They need friends.
No.
They need more friends.
We need cubbies.
I don't want to live in a tent.
We need cubbies and we need to place them on every outer state line. And we need people to be able to sleep in the night, okay? Sleep through the night without nightmares.
REI is going to be a very big company if she is president because they're going to be selling a lot of tents.
I love
a
REI.
lot.
REI is a great
And
place.
you know what? Probably they won't even make money because they'll probably smash the glass and steal the tents.
And this man is a crook.
I'm no crook.
Listen
I'm no
to
crook. We
nothing
know
that
what
he
you
says.
did. You did nasty
This man
things.
is filled with just lies.
And by the way,
full lies. I think jail.
excuse me.
Yeah, I'm not
little
little.
Kamala.
I'm
little
not that
Kamala.
little. Not little.
She's so little.
I'm full grown.
like a
all
baby.
right? I'm
A
fully
baby.
grown.
Look at her, like a baby.
Okay.
A baby in
Only-
a suit.
Only Doug calls me baby, right?
You know,
In
Doug.
bed.
You know, Doug. Doug. He's probably a eunuch.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and stocks were very mixed on Friday after rate cut euphoria kind of faded. There were winners, there were losers. I would call today a digestion day. There wasn't economic news or data. The market was just grappling with the same things it was all week, and that was the retail sales data, the housing data, the rate cut, as well as the jobs data, just grappling with that, giving some back, digesting all of the news and taking some profits into what is going to be a volatile week next week. Today was also triple witching. Stock options, stock index futures, and stock index options all expired on the same day, and that often does bring volatility. We saw the best performing sectors being utility and staples. Utilities was up 2.7%, staples up 0.5 percentage point. So the market definitely getting a little bit defensive ahead of next week. There is a big week of data as well as earnings next week. We get data related to the employment situation, durable goods, inflation data, as well as manufacturing data, and a ton of Fed speakers. So the market positioning today in defensive sectors ahead of next week is no surprise. We then saw every other sector fall except communication services. They were flat on the day and every other sector was red, with the worst performing sector being industrials, materials, and technology. So pretty much the big winners this week, they were the worst performing sectors today. And again, it was just that digestion happening under the hood, as well as just the market giving some back and positioning itself for next week. We saw broad-based selling across small caps, mid caps, and large caps, with the large cap core being the best performing sector. So this would pretty much be, those defensive sectors, and every other factor and size being in the red. Small value and small core really took it on the chin today, but again, very similar to what we saw this week. They were the best performers heading into this Friday trading session, and they gave the most back, to be expected, and they are the small size segment, very, very volatile nonetheless. But despite Friday's muted action, the major averages closed out the week with gains. Much of those increases stemmed from Thursday's market surge as investors embraced Jerome Powell's message that the Federal Reserve made a big interest rate cut to support the economy, not to save it, an idea bolstered by the jobless claims data and the strong data we got this week. The RTY, the Russell 2000, was up 2.2% this week. The Nasdaq 100 up 1.44% this week. The RSP and the S&P 500 pretty much up 1.3% for the week. So a very, very strong week, and a lot of the gains came here on this Wednesday, Thursday. Thereon gave a little bit back on Friday, but still a positive week nonetheless, and you take those gains when you come. Looking at sectors for the week, the best performing sector was actually energy, followed by financials, then comm services, and discretionary. So highly sensitive, highly cyclical sectors were the best performing sectors, up as much as 3% in some cases. We saw the S&P 500 right here up 1.07%. Most sectors did beat the SPY, and even names like technology up nearly 1% on the day, but completely outperformed by the broader market. And then the worst performing sectors this week was healthcare, staples, real estate, so pretty much defensive sectors. And it really goes to show that this week was risk on, regardless of the price action we actually saw here on Friday. Despite all of the action we actually saw in equities today, commodities were very strong. Gold and silver both up 1.4, 1.25% respectively. The dollar gained ever so slightly on the day, and that's because yields actually rose on the back of stronger economic data this week, and as a result, bonds fell, TLT falling 0.38%. The biggest losers today were equities, particularly the smaller cap segment of the market. The IWM down a full percentage point today, the S&P 500 down 0.19%, and the Nasdaq roughly the same, but the IWM up ever so slightly in extended hours, 0.2%. So a little bit of upbeat action we're seeing there. The RSP down 0.36%, mid caps down 0.7%, and the SP600 down 1.05%. So really large caps were the biggest winner here today, at least in terms of outperforming the broader market to the downside. Looking at the S&P 500 though, guys, the advanced decline line did exactly what the market did, and that's pulled back a little bit from its all-time highs. Very constructive price action. I wouldn't say that today's trade was anything to be concerned about. I think it was just the market positioning itself for next week, and also taking a bit of profits after a strong rally on Wednesday and Thursday. The gamma flip zones have not changed, so we actually did see a bit of resistance at this 5750 area. We've pulled back. The 5575 area is still the gamma flip zone. Guys, remember, we want to lean bullish above the gamma flip, buying dips, selling rips, and below we want to lean bearish, buying into strength, selling into weakness, and aiming for our obvious targets of the put support, call resistance, which is 5500 and 5750 respectively. So based on where this is right now, I do see asymmetrical downside to the 5575 area. That doesn't mean we're going to sell all the way there. It just means that the probability suggests that we do see downside before we do see upside next week. Nonetheless, this market is strong. We clocked an all-time high last week in the context of a higher low being put in right here relative to this low. A very constructive price action, and the double top bears got absolutely smashed, and I think we are going to continue this trend higher, but we are in a volatile September period. Do brace for volatility, and if we do get to the 5575 area, I think this is a great position to add exposure to go ahead and rocket up. I think we're going to find strong support right here or wherever the gamma flip zone moves to. But let's actually go to the US 500 chart, hop on the weekly chart, and you could see a new weekly closing all-time high. Very constructive, higher highs, higher lows in the S&P 500 to an all-time closing weekly high. Guys, this is bullish, and look at this, higher low, higher low, higher low, new all-time high. That's very, very constructive. And unless we actually go ahead and break this level right here, this key level, okay, I just want to be buyers of dips, and that level is 53.91. So on the weekly chart, if we go ahead and sell and actually break the gamma flip zone, I would only be really looking to the 5400 area for that support on the weekly chart to come, right? And I would still remain bullish. If we do break this area, things look a little bit grim, then we can see extended sell side. But on the weekly chart, the 53.91 area is the area where I would get bearish below, but stay constructively bullish above, regardless of what happens this September. And so far in the month of September, we just pull up, we're actually up in what is normally a volatile month, but the month isn't over, so we can't really look at the monthly chart. Diving into the daily chart, now I do know we use the gamma flip zones, but you can see this is actually where the weekly zone is. So unless we actually pull back to here on the weekly chart, that's where I would start to get worried about the market. But until this area right here, I remain bullish, and it's a long way to get there. The S&P 500 would need to sell about 5%, and it would take a solid, at least 5 trading sessions to get there, especially in this type of bull market where all dips are bought relentlessly by the bulls. So now guys, there may be a little bit of downside on the daily chart to the gamma flip zone, but this is where I would get long on the daily chart. But on the weekly chart, things are looking rather constructive, and you do just want to buy all dips all the way up until the 5400 area. And even when we get here, we'll assess what the market is looking like to see if we do actually position ourselves long or sit through the volatility. Nonetheless, a weekly closing high, an all-time high made this week, things looking very, very strong for the S&P 500. And really, any pullbacks we do get, you just want to add exposure, not just this week, but throughout the next 4 weeks, all the way up until the end of October, because I do think the end of year rally is coming. I just want to make that clear. I do think an end of year rally is coming that's going to go into early to mid February, but we just have to get through this volatile period first. Looking at the RTY, constructive as well. As long as we hold the gamma flip zone, I think we should aim for the 52-week high area of 3707 right there. But we will see a little bit of volatility, and this red day, not really a big deal because we had 7 green days in a row for the IWM. That's a week and a half of trade, 7 trading sessions, right? So the first red day in 7 trading sessions, I think we find like support here at the 2200 area, and then aim to break these highs and this high in the IWM next week or in the next couple of weeks if the economic data comes our way next week. Looking at the RSP, my favorite chart, looks very, very strong, but actually the S&P 500 may actually look a little bit stronger. Nonetheless, guys, we've said this before, the 171 area is where I want to be buying big amounts of dips in the RSP, but if you want to add exposure before that, you can actually just look at the 175 area. I think if we do pull to this area right here, we'll find support and then continue to make another all-time high. But if we break this area, look to the 171 as the next zone to bounce and add exposure in the RSP. The Nasdaq 100, the NDX, constructive. It found resistance at the put support. That's why these zones work so well. Where do I find support? I think we just look at the 19,100 area and potentially the 19,250 area right here. You know, if we do fall and find support in this zone right here, that would be constructive. And as long as we remain above this low we put in right here, which is a higher low relative to this low, things look constructive for the Nasdaq. This is an equal high, by the way, and we are now chasing this high right here. What we need to do is sometime next week find a level of support and then break above this high right here, or have the core resistance move up, and then we can target new all-time highs in the Nasdaq 100. But guys, all of these charts looking very, very constructive and looking for us to move higher, but a lot of economic data next week can derail this freight train along with the Fed speakers. A ton of Fed speakers are speaking next week, so do be prepared for volatility and buy dips at strategic places. And those dips are the 19,100 area for the Nasdaq 100, the 2200 area for the IWM and the 2150 area, and the 5575 area in the S&P 500. Those are places to add exposure because we will be taking out all-time highs again in the next couple of weeks.
And for everything we've seen this week, guys, sometimes we have to take a step back and we have to look at the data. And next week, we are going into a post-OPEX week. The September OPEX is officially behind us. And this is the returns in the last 50 years in this September post-OPEX week. And things can get volatile. We can see average returns negative 0.96 here in the last week of September, median negative 0.82%, 16 wins, 34 losses. So do expect volatility in the next week. And if we do get a significant pullback, that would be historically normal. But looking longer term, things look rather bullish. Whenever the Fed has cut within 2% of all-time highs, you can see in the next 6 months and 1 year, things were very, very bullish. That is the case here in 2024, a 100% win rate 12 months later, average return 13.9%, median about 10%. So you're either going to get the average return or upside from there in a cutting cycle when the S&P 500 was near all-time highs. We see similar scenarios 3 months and 6 months after, 75% hit rate, average returns 3% and 6% respectively. But in the next month, we can actually see near-term volatility with a rather poor 45% hit rate. So near-term volatility, you can expect that, but longer term, you do want to buy any type of volatility we do get because the returns tend to be outsized. And when you put things into perspective, the bull market is still in its early phase, but we will need catalysts to keep pushing us higher. And one of those catalysts could be money market funds. Right now, there's 6.8 $1.7 trillion sitting in money market funds, just money waiting to be put into the market. But while this is untapped cash on the sidelines, it is unlikely to make its way in the market in any significant way, not at least while rates are where they are. In fact, money market outflows were only ever seen when the Fed funds rate got below 2%, and we got the Fed's long-term economic projections, and they see the Fed funds rate at the end of 2025 at about the 3% mark. The exact figure was actually about 2.9%. So while some of the money may come out of money market funds, it's not going to be anything significant that's going to really move the market. What's really going to move the market is going to be liquidity from banks and the central banks, as well as economies, as well as various governments, not necessarily retail traders with their cash on the sidelines. But let's say you wanted to deploy cash. What's a good place to put your money, and where can you find value? And one place is actually just looking at value stocks. Value versus growth valuations remain well below its historical average. This is the Russell 1000 value versus growth indices. We're at 2 standard deviations below the average, and so value stocks trading at quite the discount. In fact, if you look at something like the Gotham yield, it's currently trading at 8.76%, the 4th percentile towards cheap, and the average 2-year forward expected returns in value stocks is looking at 19.59%. And if you guys want value, you want to look at something like the Russell 2000 and potentially just small cap indices. They tend to have a lot of value names, or are more weighted to value names. But do be careful, because small cap 2024 growth expectations have come down significantly since the start of the year. Around the January time period, fourth quarter expectations here was 25%, now sitting at 15% growth. So we've seen a massive down revision. The same is true for the third quarter. 14% was growth at the start of the year. The expectation at the start of the year was 14%, now sitting at -3% for the third quarter. And the same is true here for the second quarter. Growth expectations was 16%, now at 1%. And that is why the Russell 2000 has really just traded sideways this year. There's been a lot of volatility, and that's because earnings expectations has seen a lot of volatility. But looking at the broader market, are stocks overvalued right now? US market valuations are about 2% overvalued. This is the total market. That while we're not extremely overvalued, we are certainly overvalued nonetheless. But a lot of that overvaluation is weighted towards these larger cap names. Large cap growth and large cap value are the most overvalued sectors. Mid cap growth there as well, but everything else is either within a fair value range or dramatically undervalued. This could be because of earnings expectations, because of the market we're in right now, election uncertainty. But if you guys are looking for value, look towards small caps, potentially mid caps in the value core, and in some cases the growth factors. You can definitely find attractively priced stocks in those indices. And when it has come to a cutting cycle, typically small caps have outperformed large caps in the 6 months after the first Fed rate cut, but have underperformed in the initial months, but have had mixed performance over a 12-month period. And guys, diving into some macro, this is the Fed's GDP now. The latest figure shows growth for the third quarter tracking at 2.9%, very strong, driven by the upbeat data we've seen this week, the initial jobless claims, retail sales, as well as manufacturing data. We got the Philly Fed manufacturing data that came in a lot better than expected. However, the leading economic indicators came out yesterday, and the LEIs essentially provide an early indication of significant turning points in the business cycle and where the economy is headed in the near term. And the LEI continued to fall in 2024, but the rate of decline obviously moderated, and the LEI is still signaling to us that a recession is pending. The LEI's weakness in orders mostly came from the ISM index of new orders, as well as the yield spread right here. They were dramatic contributors to the LEI's continued decline in August and have been the major indicators, along with the average consumer expectations for business conditions. So essentially, business sentiment. These have been the major driver of the underperformance in the LEI, and the LEI actually did trigger a recession signal in terms of growth expectations this month. And with the LEI signaling a recession, this is part of the reason why the Fed actually decided to cut rates. The economy was clearly weakening, and that is why we're currently in a cutting cycle. And this is very interesting data from BOFA. This is the Fed Fund Futures pricing of implied policy path on the onset of cutting cycles. So you can see here that this is what the expectation is right now: 200 basis points worth of cuts over the next 8 meetings. This is every other cutting cycle we've had since 1995. So the Fed's cutting cycle right now is notably faster compared to every other easing cycle. And that's because we probably went on the most dramatic hiking cycle ever. But the actual easing delivered within the first year of past cutting cycles compared to the 2024 implied rate shows something very different. So while the implied rate was minimal, we actually saw more cuts in general. And this path right here is probably more indicative of what will actually happen and what has actually happened. So we are in a cutting cycle, guys. And now the big thing we want to look to is lower rates having a positive effect on the economy. And we have started seeing that. Housing affordability rose 1.2% year over year and 1.8% month over month in July. This is affordability versus the Freddie Mac 30-year mortgage rate. And that's a really, really good thing. And this is actually only going to get way better in August and September with the major drop in rates as well as the Fed rate cuts. So if we continue to see housing affordability go up, the unemployment rate to come down, and we still see inflation to moderate, that is the sign the economy is holding in there. And in that instance, equities, cyclical equities, growth equities do very, very well. And looking at next week, guys, looking at earnings, we have a light week of earnings. There is a couple of notable names, particularly from Wednesday onwards. We have Micron after the close, Concentrix, as well as Jefferies. Then on Thursday before the open, we have Accenture and Costco after the close. Very, very interesting. And that's about it in terms of big names for the week. But we also have stuff like Progress, AutoZone, AAR, as well as CarMax this week. So guys, a light week of data, but certain sectors can see volatility, particularly in semiconductors, the memory side of semiconductors, as well as staples, the growth side. That if Costco's earnings are good or bad, we can see some volatility in those names. But what's really going to bring the volatility next week is actually going to be data. We have a huge week of data following this Fed rate cut. We have so many Fed speakers, Powell speaking on Thursday, Fed Williams, Fed Barr, Kashkari, Bostic on Monday, Goldsby and Kashkari again. A huge amount of Fed speakers are going to be speaking just to see where they stand on the rate cut, the economy, and the markets as a whole. We also have the manufacturing PMIs, composite, as well as services on Monday. That's a very, very big data point. Then we get the housing price index, consumer confidence, and home sales on Wednesday, right? Then Thursday is when things really kick off. We get PCE expenditures, the quarter over quarter, the second quarter revisions. Then we get the durable goods orders, right? The GDP figures as well, and then initial jobless claims all on Thursday. So that is going to be a huge day that's really going to move the market, along with these Fed speakers that we spoke about previously. Then on Friday, we actually get the PCE figures month over month, headline and core, and then the Michigan consumer sentiment. We also get the personal income outlays. So we get personal spending and personal income. And these two figures right here, personal income and personal spending, they go directly to the employment situation as well as the inflation situation. So I think the market's really going to look at these two first and then the PCE numbers. We do know that inflation is on its way lower. We are in a disinflationary trend, but it's now up to the labor market, and personal income and personal spending, that goes directly to the employment situation, and the market is going to be heavily focused on that, as well as initial jobless claims and the PMIs. We want to see how the economy is holding up. So big week of data, guys, so be prepared because September can get volatile. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.